A Santa sell-off coming to the markets to start the year, with the stocks falling for the last 5 days in 2024 and the first 2 days here, and we'll see exactly where things end here today in 2025. But the longest losing streak since April, we should note, of 2024. However, our next guest says that the bull market is alive and well, and if you don't buy now, that it could be an expensive mess. Joining us now is Callie Cox, Ritholtz Wealth Management's Chief Market Strategist. Great to have you here with us, and Happy New Year to you, Callie. First and foremost, as you think about even the valuations right now for some of the most overcrowded trades, which is essentially long mag 7, how is it that now could be the time to buy the dip versus kind of waiting to see how things play out over these next few weeks going into the inauguration?
First of all, Happy New Year. It seems like we're in a new year, but not much has changed. That's the way it goes, Brad and Maddie. Well, you're right. The market looks pretty expensive here, but if you dig underneath the surface, there still are pockets of value, Brad. And that's what I'm talking about when I say that this market still has legs to run on. Of course, the economy is doing pretty well at the moment. There are some signs of weakness. If you look from a broad bird's eye view, corporate America is in a good position. The U.S. consumer is in a good position. And if there are pockets of value in the market, especially outside of tech, then I'd say that that's a good time to step in, especially if we see prices continue to decline from here. Because everybody knows the classic investing advice is buy low, sell high.
Where do you find that value, Callie, and how do you suss out the value of value stocks versus the risk of those stocks?
Well, that's a good question, right? Because the other argument you could make is that value hasn't worked in a really long time, Maddie. And I mean, that's also true. I mean, tech is dominant for a reason. But right now you see profits broadening out across the sector. I still think some rate sensitive sectors look interesting right now, although I'm getting a little less excited about them now that the Fed is committed to keeping rates somewhat high for a bit and inflation concerns are coming back.
All these things considered, as we're thinking about some of the core metrics that analysts are going to be grading the companies who are going to talk about macroeconomic conditions, that are going to talk about the changing of the, who's occupying the seat at 1600 Pennsylvania Avenue as we begin the earnings season. S&P is still looking for calendar year, or FactSet is looking for S&P 500 calendar year 2025 earnings growth of 15% here. What would need to happen in order for us to see that come to fruition over this calendar year?
Yeah, well, let me note, first of all, 15% earnings growth in a year is incredibly good. That would be the best year since 2018. And I look at Bloomberg estimates, but Bloomberg analysts surveyed by Bloomberg see profit growth across all 11 sectors in the S&P 500, something that also hasn't happened in several years. So Wall Street expects another good year for corporate America. And I think you see that driven by, an increase of sales and continued management of costs. But, you could also see a little bit of cost management through productivity as well, which is something that I'm watching, Brad. It's not something that you'll see show up in an earnings report, but something that you'll hear management teams talk about. I will put a caveat in there, though. We have a lot of policy speculation right now. We're not sure, what will be enacted and how quickly it will be enacted. So that's still a really big question mark. I expect management teams to start talking about that in this next earnings season. But for now, I'm not really factoring that into how I think about markets. It's still a question mark.
Well, I do want to talk a bit about that productivity boost that we've seen, particularly since 2020, Callie, and you do such great work on this exact topic. But I guess I wonder what the tipping point is for when productivity is good for stocks because it helps companies maybe cut costs, cut back on labor, versus when that becomes a macro problem where there's too much cost cutting in the form of cutting jobs, and then it creates an issue for the macro picture.
I think that's a big question that so many people on Wall Street are trying to answer right now, Maddie. And we can start with the fact that productivity historically has been really good for the economy and the stock market. It shows that technological innovation is sound, it's growing, and that both workers and companies are getting what they want. Workers are getting, higher wages, stronger skill sets, and companies are getting, more output. And through more output, they're getting lower costs per unit produced. Of course, the economy has changed a lot in the past few decades. We're more of a service-based economy. Productivity gets a little weird there because it's hard to, measure, for example, the amount of haircuts given at a salon or something. It's more of a manufacturing type phenomenon. We also have this question about AI, and I know that there's a lot of worry around, what AI could mean for the workforce. But right now, there's not a lot of, real evidence to back up the fact that it could cut into the number of jobs available. It could be a productivity boosting tool, and that could actually allow companies to grow their ability to produce or to have more people on staff. So still a big question mark for me. I think that that's a really interesting thought exercise, but definitely one that a lot of people are stressing out about these days.
All right, with the absence of the Santa Claus rally, does that kind of yield any prevailing thought about a unsung outperformer that you believe is best positioned in terms of an opportunity scope here for 2025?
Well, tech has led the fall that we've seen during the Santa Claus rally period, and I'm not so shocked by that. I mean, tech, like I said, has been a dominant story in U.S. markets, and for good reason. But a lot of times when you see market weakness, you see those high flyers lead on the way down. And we've been telling our clients to think about balance in their portfolios. Think about how far tech has run. Maybe consider taking some profits there, rotating into more unloved sectors. And right now, you're seeing one of those big case studies for why that's important. I don't know how far the market falls from here, Brad. I certainly don't assign too much weight to seasonal patterns. Just because the market is falling during the Santa Claus rally period doesn't mean that we're doomed. But at the same time, I think it is a really good reminder to look for that balance in your portfolio and understand that this bull market hasn't benefited all sectors, and that could be an opportunity for you.
All right, Callie Cox, always a joy to speak with you. Happy New Year.
Happy New Year.